Now, I was very cautious about the trade for very obvious reasons. We'd seen a very strong move back down against us on the metals. So I was willing to buy it, but I wasn't willing to cross the spreads to get it. In other words, I'm not willing to pay 81.2s or anything like that. If I don't get my price at 80.9, I don't get any price at 80.9, right? I don't get any price. So I was willing to bid it, and you can obviously see the trade in relation to the value just now. You can see what we were doing. You can see where we were doing it. There's the trade in relation to value. I paid 80.9 for 5 contracts, so I got in at 80.9 for 5 contracts. What do you think, guys? Is that a trade you could all mimic? Is that a trade you could all do? Is that a trade you would want to do? Let's take a look at the dollar. Well, sure, of course you're wanting to do the trade, but you want to do the trade with a lean. You want to do the trade when you see the buyers coming in behind your trade, but you don't want to pay across the spreads for it. And the reason why you didn't want to pay across the spreads was when the metals market opened, we got a sizable press. When the metals market opened, we got a sizable press. We still have macro value, so we have to trade a macro level, which is this price, 81s. And obviously bidding into that has now been a relatively straightforward $100 winner, guys. $500 on a 5-lot. Life really is pretty good. Now take a look at the size of the dollar value divergence. Do you see the dollar value divergence? Remember I said 18 or higher? Remember I said 18 or higher? 22 ticks, guys. 22 ticks again. Is that a benchmark? What do you think? Possible, right? That is a possible quality benchmark. It might only go for 10 ticks. It might go for $1,000. Who cares? It's still a benchmark. The entry process is still benchmarkable in terms of opportunities. Cash open, guys, in about 20 minutes. Our little buy trade in oil didn't do too shabby, did it? We eventually traded 85.70s. We bought it, remember, at 84.90s. 84.90s. It's just traded 85.70s. And value started to come right out the trade, and it got basically almost a banker sell at 85.60. Did anybody sell the 85.60 flip? Or did you not bother? The reason why 85.60 is a good price is because it was the half-back trade area. So we had the half-back trade area, okay, so we had a couple of things going for us here. So this was obviously the change of behavior in the background. It was also the half-back trade area. Take a look at the top edge. So there was the top edge, there was the bottom edge. 85.60 is the half-back. Everybody know that, yeah? Everybody had that on their charts. So there's the half-back trade area there. So if we now know that that's a half-back, we've now got a change of behavior in the background. And then we see the blue line making higher highs, higher lows, yes? Higher highs, higher lows. So if it's making higher highs, higher lows, and then the red line makes lower lows, you've got your bubble. If the red line is not making lower lows, because it wasn't making lower lows here, it finally started to make lower lows, lower highs here, correct? You've now got your bubble. Now what you do with the bubble is you start now measuring the red line. So you bring your indicator into play here, your indicator being an upright, and you start drawing in your red line. As the red line falls, you draw in your red line. So when you see the red line, and then it rallies here, you draw a line on your charts, yes? Anything above that line is now a sell. Assuming you want it for other reasons, right? Assuming there's other reasons why you could take a sell, everything above that is now a possible sell. Well, the volume was below you as well. The biggest volume was here. So the volume's below you. That is a benchmark. Dollar divergence.